Let's say you had $10,000 to invest right now. What would you do with it? Would you buy the hottest stocks, gamble on cryptocurrency, or stash it in a savings account? How can you turn your first $10,000 into $1 million? It sounds impossible, right? Well, it's not. In fact, it's been done before by some of the most successful investors in history, and they all followed the same strategy: value investing. Hello, everyone, and welcome to Fun Financial Insights, where I share tips and tricks on how to make smart money decisions. And in today's episode, I'm going to show you how to invest your first $10,000 based on the advice from the book, The Intelligent Investor by Benjamin Graham. This book is considered a classic text on value investing, which means buying stocks that are undervalued by the market and holding them for the long term. Graham was the mentor of Warren Buffett, one of the most successful investors of all time, so his advice is definitely worth listening to. Before we dive into the details, let's first understand the difference between investing and speculation and why investing is a better way to grow your wealth in the long run. Investing is buying an asset with the hopes of getting returns that are higher than the amount you invested. Investing is based on careful analysis, research, and risk management. As an investor, you focus on the long-term prospects of a company and you buy stocks that are undervalued, meaning that you have confirmed they are worth more than their current market price. Now, speculation, on the other hand, is buying or selling an asset with the hopes of making a quick profit from short-term price fluctuations. Speculation is based on emotion, rumors, and market psychology. Speculators chase trends and follow the crowd, and they buy stocks that are overvalued, meaning that they are worth less than their current market price. Why is investing better than speculation? Well, because investing is a rational and disciplined approach that aims for consistent and substantial gains, while speculation is a risky and emotional approach that relies on luck and chance. Investing reduces the uncertainty and volatility of the market, while speculation increases it. During the dot-com bubble of the late 1990s and early 2000s, many internet companies with little or no earnings and revenues saw their stock prices soar to astronomical levels, driven by huge hype and speculation. Many speculators bought these stocks hoping to make a fortune, but when the bubble burst, they lost most or all of their money, while investors who avoided these stocks and instead bought stocks of established and profitable companies that were trading at reasonable prices, such as Microsoft, Coca-Cola, or Walmart, were able to preserve and grow their capital. Another example is the recent frenzy over meme stocks, such as GameStop and AMC Theaters, which saw their stock prices skyrocket in a matter of days, fueled by social media and online forums. Many speculators bought these stocks hoping to ride the wave and cash out at the peak. But when the momentum faded, they were left holding the bag. Investors who ignored these stocks and instead bought stocks of high quality and growing companies that were trading at attractive prices, such as Apple, Amazon, or Netflix, were able to enjoy steady and solid returns. Now that you know the difference between investing and speculation, let's see the steps to invest your $10,000 based on Graham's principles of value investing. We hope you're finding this video helpful and interesting. If you are, please hit the like button and subscribe for more content just like this coming out shortly. So, how should you invest your first $10,000 if you want to become an intelligent investor? Well, here are the steps that I recommend. Pay off any high-interest debt. This is the first and most important step because debt can eat away at your returns and limit your ability to invest. If you have any credit card debt, personal loans, or other debts that can charge you more than 10% interest, pay it off as soon as possible. This will save you money in the long run and free up your cash flow for investing. You can allocate 10 to 20% of your $10,000 to settle high-interest debts. Invest in a diversified portfolio. A diversified portfolio is a collection of different types of investments that balance risk and reward. Graham suggests dividing your portfolio into two parts: stocks and bonds. Stocks are shares of ownership in a company that can increase or decrease in value over time. Bonds are loans that you make to a government or corporation that pay you a fixed amount of interest over time. Stocks are more volatile and risky than bonds, but they also have higher potential returns. Bonds are more stable and safe than stocks, but they also have a lower potential of returns. Graham recommends that you allocate 50% of your portfolio to stocks and 50% to bonds, and adjust this ratio according to your age, risk tolerance, and market conditions. For example, if you are young and willing to take more risk, you can increase your stock allocation to 60% or 70%. If you are older and want to preserve your capital, you can decrease your stock allocation to 40 or 30%. If the market is overvalued and stocks are expensive, you can reduce your stock allocation to 25% or less. If the market is undervalued and stocks are cheap, you can increase your stock allocation to 75% or more. Value investing, choosing the right stocks and bonds. So how do you choose which stocks and bonds to buy? Graham advises that you follow the principles of value investing, which means buying stocks that are trading below their intrinsic value or the true worth of the company. To find these stocks, you need to do some research and analysis, looking at the company's financial statements, earnings, growth, competitive advantage, and future prospects. You also need to compare the company's market price to its book value, which is the value of its assets minus its liabilities. Graham recommends buying stocks that have a low price to book ratio, which means that the market price is less than the book value. This indicates that the stock is undervalued and has a margin of safety, which is the difference between the market price and the intrinsic value. The larger the margin of safety, the lower the risk and the higher the potential return. For bonds, buy high-quality bonds that have a low default risk and a high credit rating. You can find these bonds by looking at the ratings issued by agencies such as Standard & Poor's, Moody's, and Fitch. Graham recommends buying bonds that have a ratings of AA or higher, which means they have a very strong capacity to pay their interest and principal. You also need to consider the maturity and yield of the bonds, which are the length of time until the bond expires and the annual interest rate that the bond pays. Generally, the longer the maturity and the higher the yield, the more risky the bond. You should also consider buying bonds that have a maturity of 10 years or less and a yield of 4% or more, which will provide you with a reasonable return and a low risk of inflation. You can buy individual stocks and bonds through a brokerage account, or you can buy mutual funds and exchange-traded funds, ETFs, that hold a basket of stocks and bonds. Mutual funds and ETFs are convenient and cost-effective ways to diversify your portfolio and reduce the fees and commissions. You can find mutual funds and ETFs that follow different strategies, such as value investing, growth investing, income investing, or index investing. Index investing is a passive strategy that involves buying funds that track the performance of a market index, such as the S&P 500, the Dow Jones Industrial Average, or the NASDAQ Composite. Index investing is based on the idea that you can't beat the market, so you might as well join it. Index investing is simple, low cost, and tax efficient, and it has been proven to outperform most active fund managers over the long term. Review and rebalance your portfolio periodically. Now, once you have set up your portfolio, you can't just sit back and forget about it. You need to monitor and adjust your portfolio periodically to make sure it is still aligning with your goals, risk tolerance, and market conditions. You should be reviewing your portfolio at least once a year, or more frequently if there are significant changes in your personal financial situation, or in the economic or the stock market situation. You should also be rebalancing your portfolio, which means restoring your original asset allocation by selling some of the assets that have increased in value and buying some of the assets that have decreased in value. This will help you maintain your desired level of risk and return, and also force you to buy low and sell high, which is the essence of value investing. We hope you enjoyed this episode and gained some valuable insights, and if you did, please help us grow our channel by liking and subscribing. Thanks for watching, and we'll see you next time. Take care.